Imagine it is May 1942.
Oh, wow. Okay, taking us way back.
Right, and you are looking at a world that is just completely engulfed in the absolute darkest, most terrifying days of World War II.
Yeah, the uncertainty then was it was off the charts.
Exactly. I mean, the American Pacific Fleet is still reeling from Pearl Harbor. You've got U-boats prowling the Atlantic coast, sinking merchant ships with terrifying regularity.
The Philippines have fallen.
Yes, the Philippines have fallen. The news cycle isn't just grim, it presents an existential threat to the global order.
Right, it's not just a recession, it's survival.
Exactly. And the Dow Jones Industrial Average has plummeted to 92. It is the absolute definition of what financial historians call maximum bearishness.
The peak terror.
Peak terror, exactly. And yet, precisely at this moment of maximum panic, the U.S. stock market does something that just completely defies all conventional logic.
It hits a bottom.
It hits a generational bottom, yeah. And it begins this massive, sustained upward climb.
Which is fascinating because the market essentially acted as a highly advanced radar.
A radar, like predicting the outcome.
Yeah, exactly.
Yeah.
It processed the aggregate data of millions of actors and somehow sensed that the tide of the war was turning. And this is months before the Battle of Midway. Months before the history books actually recorded the shift.
That's wild.
It really is. It looked over the horizon, past all those immediate storm clouds, and it priced in a future survival that, honestly, no individual human mind could confidently predict at that exact moment.
So the market acted as a radar in 1942. And today, for everyone listening, we are exploring exactly how you build that same radar to shield your wealth today. Welcome to another deep dive on the Wealthnetic channel.
Glad to be here.
Our mission today is to really dissect the mechanics of strategic capital allocation. We're looking at wealth preservation during times of extreme uncertainty, global conflict, economic turbulence.
Because the game really changes when the environment deteriorates.
Right. We are looking at how the ultra-wealthy construct these legal, geographical, and financial architectures that basically act as an impenetrable defense.
Yeah, and I think it's important to state up front that true wealth preservation requires an entirely different operational framework than wealth creation.
How so?
Well, think about it. Accumulating capital during a roaring bull market is largely a function of taking on correlated risk, right? You're riding the wave.
Sure, everybody looks like a genius in a bull market.
Exactly.
Yeah.
But preserving that capital across generations through inflation spikes, geopolitical fracturing, and, say, systemic banking failures, that requires stripping away correlated risk.
Okay, stripping it away.
Yeah, it demands a deep understanding of defensive architecture, how to shield assets from currency debasement, aggressive lawsuits, and even the overreach of sovereign governments.
And we are pulling from an incredibly dense stack of sources today to figure out exactly how that architecture is built.
It's a great stack today.
It really is. We have historical market data from the World War II era, geopolitical analysis of the world's most aggressively neutral nations from IMI Daily.
Which is fascinating stuff.
Totally. Plus, comprehensive legal breakdowns of offshore asset protection structures, like the Cook Islands Trust, and the underlying capital allocation philosophies of titans like Warren Buffett.
That's a lot to cover.
It is. So let's unpack this. Let's start with the fundamental philosophy of capital allocation. We need to look at how institutional level investors categorize their wealth, which breaks down into what we can call the Buffett paradigm.
Right, the three buckets.
Yeah. He segments the investment universe into three rigid categories: currency-based assets, non-productive assets, and productive assets.
And this categorization is entirely based on the mechanics of value creation and, honestly, value erosion over very long time horizons.
Let's start with the first one. Currency-based assets.
So we look at currency-based assets. We're talking savings accounts, money market funds, sovereign bonds. The conventional retail investor views these as the ultimate safe harbor.
Because the nominal value doesn't fluctuate, right?
Yeah, exactly. $100 today remains $100 tomorrow. But the Buffett paradigm identifies these as mathematically the most dangerous assets to hold over a multi-decade timeline.
Wait, the most dangerous? More than stocks?
Oh, absolutely.
Yeah.
The mechanism of destruction here is the structural requirement of fiat currencies to inflate.
Right. The erosion of purchasing power is just baked into the mathematical model of a debt-based fiat system.
It has to be.
Because if the monetary base expands faster than the aggregate economic output, the purchasing power of each individual currency unit just has to decline.
Right, it's basic math. Buffett doesn't define risk by volatility. Like a stock going up and down 10% isn't risk to him.
Then what is risk?
He defines risk by the probability of losing purchasing power over time.
Oh, okay. That makes sense.
I mean, just look at the empirical data on the US dollar. Since the late 1960s, the dollar has lost roughly 86% of its purchasing power.
86%. That is brutal. It's relentless. And the mechanism is it's unforgiving. If you lock your capital in a fixed yield instrument, say a 30-year treasury bond yielding 4%.
Oh, yeah.
And the real rate of inflation, the actual cost of living, runs at 5 or 6%, you are locking in a guaranteed mathematical loss of purchasing power.
So you are trading nominal stability, the feeling that your account balance isn't dropping, for real wealth destruction.
Precisely. You're slowly bleeding out, but calling it safety.
Wow. Okay, which moves us into his second category.
Yeah.
Non-productive assets. Mm-hmm. And the classic example here is gold, right?
Yeah.
Or in the modern digital era, non-yielding cryptocurrencies.
Yeah, the golden brick, so to speak.
The golden brick. I like that. The mechanism here relies entirely on external demand. Like the asset does not produce a cash flow.
Right, doesn't yield a
It
dividend.
doesn't manufacture a product. It doesn't charge rent.
It just sits there. You are acquiring the asset based on the calculation that the broader market will experience a heightened state of fear or currency devaluation sometime in the future, which would compel someone else to pay a higher premium for that exact same inert asset.
Exactly. It relies completely on the psychological state of the market. And Buffett critiques this because the asset itself does not compound.
Right.
If you own an ounce of gold and you hold it for 400 years, you will still simply own 1 ounce of gold.
It hasn't had any little gold babies.
Exactly. It cannot reinvest its own output to generate additional output. It requires the owner to continually absorb the opportunity costs of not having that capital deployed in a compounding vehicle.
Which brings us to the third bucket, the absolute holy grail of the Buffett paradigm, productive assets.
The golden goose.
The golden goose. Businesses, commercial real estate, agricultural land. The mechanism of wealth preservation here is intrinsic output, right?
Yes. A productive asset generates goods or services that possess utility independent of the currency they are priced in.
And the critical defense mechanism of a high-quality productive asset is pricing power.
That is the key phrase right there. Pricing power.
Let's break that down. Say you have a dominant consumer brand or a vital infrastructure company. When the central bank dramatically expands the money supply, causing the nominal cost of raw materials and labor to surge, what happens?
Well, a company with true pricing power simply adjusts its prices upward.
Right. It passes the inflationary pressure directly to the consumer without suffering a catastrophic drop in demand.
Exactly. The business acts as a conduit. It absorbs the inflation and maintains its real return on invested capital. So the asset inherently protects its own purchasing power.
And the mathematical result of that mechanism is just staggering. I mean, look at the compounding engine of Berkshire Hathaway.
Oh, it's incredible.
Driven almost entirely by the acquisition of productive assets, they've generated an annualized return of 19.9% since 1965.
Which dwarfs the S&P 500.
By a mile.
Yeah.
And the power lies in the reinvestment dynamic, right?
Yeah.
The productive asset spits out free cash flow, and that cash flow is immediately redeployed to acquire more productive assets.
Creating a geometric expansion of wealth. It's the snowball effect. The cash flow generated by a farm can be used to buy an adjacent farm.
But the gold bar cannot buy another gold bar.
Exactly.
Okay, but here is where the framework presents a massive contradiction that we really need to unpack.
Let's hear it.
The underlying premise is that currency-based assets are structurally guaranteed to lose purchasing power, making them the most dangerous long-term holding.
Right.
Yet, Warren Buffett routinely holds staggering amounts of cash on the Berkshire balance sheet. I mean, frequently north of $100 billion.
Yeah, closer to 200 or 300 billion lately.
Exactly. So if cash is a melting ice cube, holding 100 billion melting ice cubes seems like a severe misallocation of capital, doesn't it?
It does, until you understand the difference between cash as an investment and cash as a strategic instrument.
Okay, explain that.
For institutional titans, a massive cash position is not held for yield. It is held as financial ammunition.
Financial ammunition. I love that term.
It is liquidity premium crystallized. Think about what happens when a severe macroeconomic shock hits a credit freeze, a pandemic, a massive geopolitical crisis.
The price of productive assets plummets.
Right. But not because their long-term intrinsic value has evaporated. They plummet because the market participants are forced into rapid liquidation to cover their immediate liabilities.
The market becomes completely illiquid. People are selling excellent cash-flowing businesses at massive discounts because they simply need dollars to survive the week.
And in that environment of absolute panic, the entity holding the financial ammunition dictates the terms of reality.
They get to set the rules.
Completely. Let's look at the mechanics of the 2008 financial crisis.
Oh, perfect example.
The global credit markets seized up entirely. Institutions couldn't roll over their short-term debt. The panic was existential. But because Buffett had held on to tens of billions of dollars in these so-called dangerous currency-based assets, he had the liquidity to act as the lender of last resort.
Right. He deployed $5 billion into Goldman Sachs.
But he didn't just buy common stock on the open market like you or I would.
No. He used the leverage of his liquidity to extract terms that a retail investor could never even dream of.
Exactly. He secured preferred stock, yielding a guaranteed 10% dividend.
10% in a zero interest rate environment, locking in a 10% yield on Goldman Sachs is extraordinary.
It's unheard of. Furthermore, he secured warrants to purchase an additional $5 billion of common stock at a strike price of $115 a share.
So he effectively engineered an asymmetrical payout structure.
Yep. He received massive fixed income while the market was terrified, and he retained the unlimited upside of the common stock recovery.
The cash allowed him to monetize the panic of others.
Perfectly said.
And we see the same mechanism way back in 1973 with the Washington Post, right?
Yes, very similar setup.
The broader market was suffering through a brutal inflationary recession. Equities were just being dumped. And Buffett utilized his cash reserves to accumulate shares of the Washington Post at roughly 25% of what he calculated the intrinsic value to be.
He wasn't timing the market. He was capitalizing on a liquidity mismatch.
Right. A $10.6 million deployment of financial ammunition grew to over $200 million.
So cash, in this context, is essentially a perpetual call option on every asset class with no expiration date.
That is a great way to frame it.
And the cost of holding that option is just the inflation rate. But the payoff of that option is the ability to acquire world-class productive assets at a 50 or 60% discount during a liquidity crisis.
Okay, that perfectly frames the utility of cash and productive assets, but it leaves that second category, non-productive assets, specifically physical gold, in kind of a strange purgatory.
It does.
Because Buffett's mathematical critique of gold is flawless. It doesn't compound. It generates no cash flow. Yet central banks around the world, sovereign wealth funds, and the ultra-wealthy continue to hoard thousands of tons of physical gold.
They buy by the truckload.
Exactly. So if the math heavily favors productive assets, the continued obsession with gold points to a massive vulnerability in the productive asset framework. What are they seeing that we aren't?
The vulnerability is systemic dependence. You see, the value of gold lies not in what it produces, but in what it mathematically and legally lacks.
And what does it lack?
Counterparty risk.
Ah, counterparty risk. The hidden variable in almost every modern financial instrument.
Exactly. If you own a treasury bond, your counterparty is the U.S. government.
Right.
If you own a stock, your counterparty involves the corporate governance of the company, the clearinghouse settling the trade, the brokerage holding the shares in street name, and the legal jurisdiction enforcing the property rights.
The entire modern financial system is just a deeply intertwined web of liabilities, isn't it?
It is. Your asset is someone else's liability. Like a digital ledger entry at a commercial bank is not a stack of physical currency sitting in a vault with your name on it.
Right. It's an unsecured loan you have made to the bank,
Which the bank has then rehypothecated and lent out to a commercial real estate developer. If that developer defaults and the bank becomes insolvent, your asset evaporates.
because the counterparty failed to fulfill their obligations.
Exactly.
Now, obviously, you are relying on the FDIC or a similar government insurance apparatus to step in and socialize the loss. But the underlying mechanics mean you do not possess the asset. You possess a contractual promise.
And that's where physical gold, held outside the banking system, comes in. It completely severs this chain of liabilities.
Because it's one of the only highly liquid assets on the planet that is not simultaneously someone else's liability.
Right. It requires no board of directors to vote on a dividend, no central bank to maintain its supply metrics, no clearinghouse to settle its exchange.
It possesses zero bankruptcy risk and zero refinancing risk.
Which is why, during periods of severe monetary disorder, such as the stagflation of the 1970s, where inflation ravaged paper assets and gold surged from $35 an ounce to over $800, the metal acts as a non-correlated insurance policy against the failure of counterparties.
However, our sources highlight a critical caveat that routinely traps investors here.
Oh, this is so important.
The mechanism by which you hold the gold determines whether you have actually eliminated counterparty risk or simply disguised it.
Yes. If you purchase paper gold, like a gold ETF, you have reintroduced the exact counterparty risk you were trying to escape.
Because you own a claim on a trust managed by a financial institution, which holds the gold at a custodian.
Right. If the custodian faces a systemic crisis, your claim is subordinate to the survival of the institution.
And even if you purchase physical gold, the storage mechanics are absolutely vital. Historically, relying on domestic storage within the traditional banking system has proven disastrous during sovereign crises.
And the supreme case study for this is the United States in 1933.
Right, under Executive Order 60102.
Where President Franklin D. Roosevelt invoked the Trading with the Enemy Act of 1917 to essentially criminalize the private ownership of monetary gold.
The mechanics of that expropriation are just fascinating. Because the government didn't just ask nicely, did they?
No, not at all. They mandated that citizens surrender their gold bullion and gold certificates to the Federal Reserve. And they gave them paper currency at a fixed rate of $20.67 an ounce.
And the penalty for non-compliance was draconian. It was a $10,000 fine, which was a massive fortune in 1933, and up to 10 years in federal prison.
And the enforcement mechanism relied heavily on the centralized banking infrastructure. Because so many citizens held their gold in bank-safe deposit boxes, the government had a logistical choke point.
They could just close the doors.
Exactly. The Emergency Banking Act allowed the government to restrict access to those vaults. When individuals went to access their safe deposit boxes, they often found themselves doing so under the supervision of an IRS agent.
That is terrifying.
It is. The state leveraged the domestic banking infrastructure to funnel private wealth onto the sovereign balance sheet. And then shortly after the confiscation was complete, the Gold Reserve Act of 1934 officially devalued the dollar against gold, repegging the price to $35 an ounce.
So the government instantly generated a massive paper profit for the Treasury, completely at the expense of the private citizens' purchasing power.
Exactly. The mechanism was a forced liquidation followed by a sovereign devaluation.
It really highlights the ultimate danger of domestic holding, doesn't it? When a sovereign nation faces an existential economic crisis, private capital held within its borders becomes the most accessible source of liquidity.
Yep. The sources also point to a 1941 property census in the United States, which further illustrates the state's capacity to map wealth.
Right. The Treasury Department required the registration of all foreign-owned property, safe deposit boxes, patents, and securities.
The state possesses a terrifyingly precise ledger of domestic wealth. If your assets reside within the jurisdictional reach of your home country, they are subject to overnight capital controls, expropriation, or aggressive taxation.
Which means the structure of the storage vault is the next layer of defense. So let's dig into the mechanical difference between unallocated and allocated storage, because this is where the illusion of ownership really breaks down for most retail investors.
Yeah, this distinction is everything. So unallocated storage, often referred to as pooled storage, is essentially a fractional reserve system applied to precious metals.
Okay, explain how that works.
When you hold unallocated gold at a major bullion bank, you do not own specific bars of gold. You own a generic claim against the bank's total pool of gold reserves.
Right.
The bank holds the gold as an asset on its own balance sheet, and your account represents a liability on that same balance sheet.
And the structural flaw here is rehypothecation.
Yes.
The bank can lend that physical gold out to other institutions or use it as collateral for their own trading operations. So multiple clients might hold paper claims to the exact same physical bar of gold.
Precisely. Now, in a normal operating environment, the liquidity is sufficient to meet withdrawal demands.
Sure, because everyone doesn't ask for their gold at once.
Right. But in a systemic crisis, where multiple clients demand physical delivery simultaneously, the fractional reserve system collapses.
A bank run on gold.
Exactly. If the institution becomes insolvent, the legal mechanics of bankruptcy law take over. Because the gold is on the bank's balance sheet, you're classified as an unsecured creditor.
Oh, wow. So you don't even get your gold back.
Nope. You stand in line behind the secured bondholders and government tax authorities, hoping to recover a fraction of your capital in fiat currency years after the bankruptcy proceedings conclude.
So you bought gold to escape counterparty risk, and through the mechanism of unallocated storage, you walked directly back into it.
You did. Which is why the alternative, which the ultra-wealthy mandate, is allocated and segregated storage.
Let's talk about that. In an allocated and segregated account, the legal mechanics of ownership are fundamentally different.
Entirely different. You hold title to specific identifiable bars of gold.
The exact serial numbers, weight, and purity are registered to your legal entity.
Crucially, these specific bars are physically segregated from the custodian's own assets and from the unallocated pool. They sit entirely off the institution's balance sheet.
And the legal distinction here is bailment versus debt, right?
Exactly. In a bailment, the vault acts purely as a custodian. They are storing your property for a fee, but they have no legal claim to it.
So if the vaulting company goes bankrupt, the liquidators cannot touch your gold to pay off the company's creditors.
Right, because the asset remains yours. It never belonged to the vault in the first place.
That is a massive distinction. But solving the physical ownership mechanics only gets us halfway there, doesn't it?
Yeah, because we still face the jurisdictional problem.
Right. If your fully allocated, segregated gold is sitting in a vault in London or New York, and the domestic government declares a sudden bank holiday or imposes severe capital controls, your gold is trapped.
Trapped behind locked doors. Your legal title is useless if the sovereign entity controlling the physical territory changes the locks on the building.
The physical asset is secure, but the operational access is severed.
Exactly. So to solve this, the defensive architecture requires decoupling the legal ownership of the asset from the sovereign jurisdiction of the owner.
You have to move the assets into territories that have engineered their entire legal and political identities around stability and non-intervention.
And this is where our sources from IMI Daily provide that deep geopolitical analysis of the 7 neutral nations.
Yes, these are jurisdictions that have literally weaponized neutrality as a macroeconomic strategy.
Let's look at Switzerland. It's the historical bedrock of this strategy. Their neutrality isn't just a political preference, it is a structural mechanism designed to attract global capital.
Right, and the foundation goes all the way back to the Congress of Vienna in 1815.
Where the European powers formally recognized Switzerland's permanent armed neutrality.
Because they maintained a highly defensible alpine geography and a well-armed militia, while refusing to enter foreign conflicts, Switzerland created this geopolitical vacuum of stability.
And that stability allowed them to pass the 1934 Banking Act, specifically Article 47, which codified banking secrecy and made it a criminal offense for a banker to disclose client information.
The mechanism was a legal fortress for capital fleeing the turbulent political environments of 1930s Europe.
It's why Switzerland still refines an estimated 70% of the world's physical gold. The infrastructure of wealth preservation is deeply embedded in their economy.
However, the sources note a critical evolution in the Swiss model recently, don't they?
They do, because absolute neutrality is a spectrum, and geopolitical pressure can force adjustments.
Right. Following the escalation of the conflict in Eastern Europe in 2022, Switzerland adopted European Union sanctions and froze billions in Russian assets.
Which really shattered the illusion of absolute unconditional neutrality. It proved that when the collective pressure of the Western financial system is applied, even the most robust neutral frameworks will bend.
The mechanism of neutrality is only as strong as the sovereign's willingness to endure economic isolation from its neighbors.
Exactly. Once Switzerland signaled a willingness to weaponize its financial system for geopolitical reasons, capital began looking for alternative, less integrated havens.
Like Liechtenstein.
Yes, a microstate wedged between Switzerland and Austria. They disbanded their standing army in 1868 and rely entirely on diplomacy and their customs union with Switzerland.
And their legal framework pioneered the foundation structure, the Stiftung, which blends the mechanics of a trust with the legal personality of a corporation, creating highly robust privacy shields for intergenerational wealth.
You also have Austria, which acts as a historical bridge between East and West. Following the withdrawal of Allied forces in 1955, Austria enshrined permanent neutrality directly into its constitution.
And further south, the sources highlight Andorra, nestled in the Pyrenees Mountains.
Operating under a unique 700-year-old co-principality system.
Historically balanced between the French state and the Spanish Bishop of Urgell. This decentralized sovereign structure has historically insulated it from being absorbed into the broader conflicts of the Iberian Peninsula or France.
But the architecture of wealth preservation isn't just confined to Europe.
No, not at all. Central America offers Costa Rica, which completely abolished its military in 1948 following a brief civil war.
They redirected the military budget entirely into education and healthcare, creating a deeply stable democratic buffer in a historically volatile region.
And in the Indian Ocean, you have Mauritius, which has positioned itself as the premier offshore financial center for Africa and Asia.
Utilizing a hybrid legal system that incorporates both French civil law and British common law.
But I think the most fascinating geopolitical pivot highlighted in the sources is Oman.
Oh, Oman is incredibly strategic.
Positioned on the southeastern coast of the Arabian Peninsula, guarding the Strait of Hormuz, Oman operates in one of the most heavily militarized and contested regions on Earth.
Yet, they have spent the last 50 years cultivating a doctrine of strict non-interference and pragmatic mediation.
They call it the Switzerland of the Middle East.
And the mechanics of their neutrality are deeply tied to their Ibadi Islamic tradition, which emphasizes tolerance and distinctness from both the Sunni and Shia majorities in the surrounding nations.
They act as the quiet back channel for negotiations between deeply adversarial states.
And Oman is actively monetizing this geopolitical stability by offering an investor residency program.
Right. For a capital injection of approximately $520,000 into real estate or commercial enterprises, an investor can secure a long-term residency.
Which highlights a crucial layer of defensive architecture: mobility. Protecting the capital is irrelevant if the individual generating the capital is trapped in a deteriorating jurisdiction.
Exactly. Obtaining second residencies or alternative citizenships in neutral nations provides a legal escape hatch. The mechanism is time arbitrage, really.
You are pre-purchasing the legal right to cross a border before the border closes.
You cannot buy fire insurance while your house is already burning.
You really can't. Acquiring a residency in Oman or Costa Rica ensures that if the domestic political situation fractures, you have immediate legal access to a safe harbor.
Now, the geographical isolation of the assets and the mobility of the individual provide robust physical defense. But the most common threat to wealth isn't military invasion, is it?
No, not at all. It is aggressive civil litigation.
A domestic judge in a highly litigious society can seize domestic assets with a single stroke of a pen.
So to defend against the legal apparatus of a sovereign state, you must construct a legal architecture that outright rejects the jurisdiction of that state.
And this is where the mechanics of the Cook Islands Trust come into play.
The gold standard.
The Cook Islands is a self-governing nation in the South Pacific, operating in free association with New Zealand. And in 1984, they engineered a piece of legislation, the International Trust Act, specifically designed to act as an impenetrable fortress against foreign creditors.
The mechanics of this legislation completely invert the traditional power dynamics of civil law.
Break that down. How does it work?
The fundamental defense mechanism is non-recognition. Under Cook Islands law, the local courts absolutely refuse to recognize or enforce foreign civil judgments against a Cook Islands trust.
Wait, so if a creditor sues you in London or New York, wins a massive judgment, and attempts to use that court order to seize your assets in the Cook Islands,
the local judge will dismiss the foreign order as legally void. The gavel of a U.S. judge carries zero legal weight in Rarotonga.
Wow. So the creditor is forced to start the entire legal process from scratch.
Yep. Flying out to the South Pacific, hiring local attorneys who are, frankly, structurally incentivized to defend the trust framework, and litigating under a legal code specifically designed to defeat them.
But the jurisdictional hurdle is just the beginning, isn't it? Because the actual burden of proof required to pierce the trust is the highest in global civil law.
It is. In a standard Western civil court, the burden of proof is typically a preponderance of the evidence.
Meaning the plaintiff only needs to prove that their claim is more likely true than not, like a 51% probability.
Right. But to pierce a Cook Islands trust, the plaintiff must prove that the individual transferred the assets into the trust with the specific and explicit intent to defraud that particular creditor.
They have to prove intent, which is notoriously difficult on its own.
But the mechanism that makes it nearly impossible is the evidentiary standard. They must prove this intent beyond a reasonable doubt.
Beyond a reasonable doubt, that is the standard utilized in criminal murder trials.
Exactly. Applying a criminal evidentiary standard to a civil financial dispute creates a near-vertical legal cliff for the creditor.
And furthermore, they must prove that the transfer of assets into the trust rendered the individual completely insolvent, right?
Correct. If the individual retains sufficient assets outside the trust to theoretically cover the debt at the time of the transfer, the claim fails entirely.
And the clock is aggressively working against the creditor, too. The statute of limitations in the Cook Islands is aggressively brief.
Typically only 1 to 2 years from the cause of action to bring their claim in the local court.
And given the massive friction of international litigation, the legal delays in the home country usually consume this entire window.
By the time the creditor realizes they need to file in the Cook Islands, the statute of limitations has already expired, and the legal door is permanently welded shut.
It's brilliant. This architecture effectively immunizes the capital from domestic litigation. The trust acts as an impenetrable vault. However, this architecture relies on the political stability of the Cook Islands.
Right.
What occurs if the local government decides to alter the legislation or if a geopolitical shock threatens the South Pacific?
Well, the ultimate defensive mechanism built into these offshore structures is the flee clause.
The flee clause, an automated legal tripwire written directly into the trust deed.
It is designed to act without human intervention. The mechanism monitors the political and legal environment of the host jurisdiction for predefined trigger events, an event of duress.
This could be a declaration of war, a local court issuing an order to freeze trust assets, or the host government attempting to enact expropriation taxes.
And when the trigger event occurs, the legal mechanics execute instantly. The primary trustee in the Cook Islands automatically resigns.
Simultaneously, a pre-appointed successor trustee, located in a completely different, safer jurisdiction, perhaps Nevis or Liechtenstein, automatically assumes control.
Most importantly, the governing law clause of the trust shifts to the new jurisdiction. The trust, legally and administratively, migrates away from the threat vector without the trust creator needing to sign a single document or authorize a transfer.
The legal entity literally teleports out of the war zone.
It's amazing.
The mechanism is brilliant because it removes human hesitation. You don't have to wait for a lawyer to answer the phone while the banking system is freezing. The trust executes its own escape protocol.
But this automation introduces a massive vulnerability, which our sources explicitly warn about.
Right. A poorly drafted flee clause is like a car alarm that goes off every time a heavy truck drives by. It reacts to noise instead of a genuine threat.
The drafting of the trigger language requires extreme precision. Historically, lawyers often used overly broad boilerplate language, such as defining an event of duress as any declaration of a national state of emergency by the sovereign government.
And the catastrophic failure of that broad language was exposed entirely during the COVID-19 pandemic.
Yes, it was a mess. In early 2020, nearly every sovereign government on Earth declared a national state of emergency to implement lockdowns and deploy health mandates.
Which had absolutely nothing to do with asset expropriation or wealth taxes.
Exactly. However, the automated legal mechanisms in thousands of offshore trusts couldn't differentiate between a viral pandemic and a sovereign wealth grab.
The broad language inadvertently triggered mass trust migrations across the globe.
And the administrative chaos must have been staggering. Trustees were automatically resigning. Successor trustees in backup jurisdictions were suddenly overwhelmed with massive portfolios they hadn't expected.
And the global banking compliance departments had to freeze accounts to conduct new Know Your Customer and anti-money laundering checks.
The capital was locked up in administrative purgatory for months. It generated enormous legal and compliance fees, all because the trigger mechanism was overly sensitive.
The failure of those COVID-19 mass triggers proves that setting up offshore architecture is not a plug-and-play solution, is it?
Not at all. The legal phrasing must explicitly define the threat vector, such as an emergency declaration specifically resulting in the freezing of financial assets to prevent the shield from becoming a straitjacket.
So the Cook Islands Trust is a mechanism to protect against an adversarial legal system. But what about protecting against a collapsing macroeconomic system? Legal shields won't stop a stock market from crashing or an economy from imploding.
Which brings us back to the ultimate macro event, World War II.
Yes. The sources dive deeply into the market mechanics during the war to demonstrate how human intuition completely fails when analyzing macro trends, while the aggregate intelligence of the market excels.
The Berlin stock market in late 1941 is the perfect case study of this aggregate intelligence.
From a purely fundamental and domestic perspective, the German economy appeared invincible. The military had swept across Europe, securing vast territories and resources.
The domestic industrial base was operating at maximum capacity, churning out armor and munitions. The state-controlled media was broadcasting nothing but absolute victory.
Human intuition would suggest the stock market should be setting record highs.
But the mechanics of a war economy are deeply distortive. The Nazi regime had instituted strict price controls and capped corporate dividends to funnel capital into the war effort. The market wasn't allowed to function freely.
More importantly, the market began to discount the future. In late 1941, precisely when the military overextension reached its absolute peak and the Eastern Campaign began to face severe logistical friction, the Berlin stock market peaked and began a sustained decline.
The collective intelligence of the capital allocators sensed the structural rot. They realized the regime's luck had crested long before the civilian population or the frontline generals fully grasped the impending catastrophe.
The market began pricing in the destruction of the Reich while the newspapers were still printing victory headlines.
And we see the exact mirror image of this mechanism in the United States in May of 1942.
The news flow is apocalyptic. The Allies are losing on almost every front. The uncertainty is paralyzing. Human intuition screams to liquidate everything and hoard cash.
And yet, the Dow Jones bottoms out and begins a relentless climb.
The mechanism of a market bottom is fundamentally misunderstood, isn't it?
Completely. A bottom is never formed when the macroeconomic data turns positive. A bottom is formed when the data is simply less bad than the absolute worst-case scenario that has already been priced into the equities.
By May 1942, the market had already priced in the potential loss of the Pacific Fleet and a protracted, brutal conflict.
When the Battle of the Coral Sea occurred, and shortly after the decisive victory at Midway, the data was still grim, but the probability of total defeat dropped significantly.
The market immediately repriced the assets to reflect survival.
The aggregate intelligence saw over the horizon.
But what absolutely fascinates me is the mechanics of which specific sectors thrive during this period. The intuitive assumption is that defense contractors, steel mills, and heavy manufacturing would lead the market, fueled by massive government contracts.
While the industrial base performed adequately, outperforming long-term averages, they were not the leaders. The absolute best-performing U.S. sectors during the war were printing and publishing, and alcoholic beverages.
The alcohol sector exploded, climbing an astonishing 723% during the war.
And the mechanics behind that are brilliant. When the global order is violently unstable, human psychology demands escapism.
People seek out immediate, highly consumable distractions, a newspaper to read about the war, and a drink to forget about it.
But there's also a mechanical regulatory reason. Heavy industries were subjected to brutal excess profit taxes and strict government price ceilings.
The government effectively capped their margins.
Exactly. But the alcohol sector, while heavily taxed, operated with far less capital intensity and possessed massive inelastic demand. They could pass the tax burden directly to the consumer without crushing their margins.
Conversely, the tobacco sector came in dead last among the 49 industries tracked.
Which is crazy because human intuition would suggest that stressed populations smoke more, which is true.
The failure was entirely regulatory. The government imposed strict, inflexible price ceilings on retail tobacco to prevent inflation in consumer goods.
Simultaneously, the cost of raw tobacco leaf, which was less regulated, skyrocketed due to supply chain disruptions.
So the tobacco companies were caught in a brutal margin squeeze. Their input costs surged, and the state prohibited them from raising their retail prices. Their profit margins were mechanically annihilated by government intervention.
The lesson here is profound. Macroeconomic assumptions like war is always profitable for defense companies and bad for consumer goods are completely blind to the nuanced mechanics of state regulation, taxation, and aggregate market intelligence.
The market constantly prices in the secondary and tertiary effects of government policy. Relying on simplistic narratives to allocate capital during a crisis is a mathematical death sentence.
To survive the crisis, the architecture must account for the state's reaction to the crisis. This is why the defensive frameworks we discussed, the allocated storage, the neutral jurisdictions, the trust structures, are designed specifically to remove capital from the regulatory reach of a desperate sovereign entity.
Which brings us to the modern application of these exact historical lessons. How does a contemporary investor synthesize the Buffett paradigm, the reality of counterparty risk, jurisdictional diversification, and market mechanics?
The sources provide a detailed case study of DR, a high-net-worth entrepreneur based in California.
Right. He recognized the deteriorating fiscal trajectory of the United States, surging national debt, increasing political polarization, and the potential for aggressive future taxation.
He realized his entire net worth was captive to a single sovereign system.
So DR recognized that his domestic assets were highly correlated to the political stability of his home jurisdiction. To break that correlation, he executed a strategic extraction of capital.
He liquidated a portion of his domestic holdings and moved $3.5 million into physical gold, which he physically transported to New Zealand.
New Zealand. It's incredibly remote, which is precisely the geopolitical defense mechanism. It is physically isolated from major conflict zones in Europe and Asia.
It has no history of military coups or domestic insurrection.
But the legal mechanics are just as important. New Zealand operates on a robust English common law system, which possesses centuries of precedent protecting private property rights. The sources note it ranks fourth globally for offshore wealth storage.
But the architecture DR utilized is the focal point. He didn't just wire money to a New Zealand bank. He utilized what the sources define as the LOCK framework: leveraged hedge, offshore security, community, and knowledge base.
Let's run through that. The leveraged hedge is the mechanism of the asset itself, physical gold, acting as a non-correlated defense against fiat inflation and counterparty failure.
The offshore security is the physical vaulting infrastructure. He bypassed the traditional banking system entirely. He utilized purpose-built, private vaults.
And the mechanics of these vaults are highly specialized. They utilize dual key access. The client holds one cryptographic or physical key, and the vault operator holds the other.
The vault physically cannot be opened without the simultaneous authorization of both parties. This prevents rogue employees from accessing the assets.
Furthermore, the assets are fully insured by Lloyd's of London and subjected to independent audits by international accounting firms. The oversight mechanism is decentralized.
But the final piece of the LOCK framework, the knowledge base, is where DR maximized his efficiency. He understood the specific tax mechanics of the jurisdiction.
The sources highlight that New Zealand tax law treats investment-grade gold and silver not as financial products or commodities subject to capital gains or import duties, but effectively as foreign currency.
This means the importation and storage of the bullion are entirely exempt from the country's goods and services tax, the GST.
By understanding the nuances of the local tax code, he established a massive capital reserve that is physically isolated from geopolitical conflict, legally protected by English common law, entirely divorced from the traditional banking system's counterparty risk, and operating with peak tax efficiency.
He built a bespoke, 21st century fortress for his wealth.
We have dissected an immense amount of complex financial and legal architecture today. We have examined the mechanical erosion of fiat currency, the strategic deployment of financial ammunition, the legal distinctions between bailment and unsecured credit, the geopolitical strategies of neutral nations, the highest burden of proof in civil law within the Cook Islands, the automated triggers of a flee clause, and the aggregate intelligence of wartime markets.
That is quite the list.
It is. Let's distill this deep dive into actionable mechanics for our Wealthnetic audience. How do you, the listener, apply these institutional frameworks to your own capital today?
The first operational takeaway is to fundamentally restructure your relationship with liquidity. You must actively build and manage your financial ammunition.
Retail investors often experience profound anxiety when cash sits in a designated account, viewing it as idle capital being slowly eroded by inflation.
You must reframe that perspective. The cash is not idle. It is a coiled spring. It is the premium you pay to maintain optionality.
The mechanism of compounding wealth relies heavily on buying productive assets at a discount. When the inevitable macroeconomic shock occurs and the broader market is forced into panicked systemic liquidation to cover their over-leveraged positions, asset prices will detach entirely from their intrinsic value.
If your capital is fully deployed, you are a victim of that liquidity crisis.
If you maintain strict reserves of financial ammunition, you transition from a forced seller to an apex buyer. You utilize that dry powder to acquire index funds, high-yield real estate, or robust businesses at distressed valuations, supercharging your long-term compounding engine.
The second operational takeaway is to relentlessly audit your counterparty risk. You must dissect the fine print of your portfolio. Look at every single asset you believe you own and ask the critical question. If the institution facilitating this holding goes bankrupt tomorrow, do I possess legal title to the asset, or do I merely possess a claim against a defunct balance sheet?
If you are purchasing physical metals, you must demand allocated and segregated storage. You must possess the specific serial numbers of the bars.
You must ensure the contract explicitly states that the vault is acting as a bailment, not a debtor, and that the assets are strictly off their balance sheet.
True wealth preservation requires severing the chain of liabilities. If you don't control the ultimate legal title, you are just an unsecured creditor waiting for a crisis.
The third takeaway is to integrate jurisdictional thinking into your capital allocation. You do not require a 9-figure net worth to recognize that geographic concentration is a massive, uncompensated risk.
If 100% of your assets, your income, and your legal identity are bound to a single sovereign nation, you are completely exposed to the political and fiscal trajectory of that specific government.
Start researching international diversification. Analyze the legal and political mechanics of the jurisdictions where your capital resides.
Does the nation have a history of aggressive capital controls, retrospective taxation, or a highly weaponized civil litigation environment?
Exploring mechanisms like holding foreign real estate, establishing offshore accounts in neutral jurisdictions, or initiating the process for a second residency or citizenship provides a structural escape hatch. It reduces your systemic exposure to domestic volatility.
The overarching thesis here is a shift in mindset. True institutional wealth isn't solely focused on maximizing the annualized rate of return. It is obsessively focused on minimizing the probability of a total catastrophic loss.
The mathematics of compounding demand survivability. The architectures of multi-generational wealth prioritize defense-building moats, establishing legal shields, and eliminating counterparty risk long before they optimize for offense.
It is about engineering survivability. Let's briefly retrace the architecture we built today. We established the Buffett paradigm, demonstrating how productive assets absorb inflation while strategic cash reserves allow you to capitalize on systemic panic.
We dissected the paradox of gold, revealing that its true value lies in the complete elimination of counterparty risk, provided you navigate the legal hazards of allocated versus unallocated storage.
We explored the geopolitical strategies of the neutral nations, utilizing jurisdictions like Switzerland, Oman, and New Zealand to geographically isolate capital.
We examined the impenetrable legal fortress of the Cook Islands Trust, analyzing the mechanics of its civil law standards and the automated defense of the flee clause.
And finally, we looked at the aggregate intelligence of the wartime markets, proving that human intuition is a flawed mechanism during a crisis. If this deep dive has fundamentally altered how you view capital allocation and defensive architecture, we'd love for you to subscribe to the Wealthnetic channel. Share these insights with someone who understands the necessity of thinking 3 steps ahead of the macroeconomic curve, and definitely explore the comprehensive source materials we referenced. The legal and historical nuances contained within them are essential for constructing these frameworks.
The architectures we've discussed rely heavily on physical isolation vaults in New Zealand, trusts in the South Pacific, gold bars segregated off a balance sheet. But the nature of the threat is evolving.
How so?
If a sovereign state in a declared state of emergency can instantly freeze domestic bank accounts, ground international flights, and physically barricade the doors to a vault, physical isolation may eventually prove insufficient.
So what's the next step?
This requires us to consider the ultimate evolution of the neutral jurisdiction. Is the premier safe harbor of the 21st century a sovereign nation at all? Or is it the digital realm?
Wow.
With the acceleration of mathematically enforced decentralized digital assets and portable intellectual property, we are witnessing the creation of wealth that requires no physical vault, relies on no sovereign legal code, and exists everywhere and nowhere simultaneously. It is an architecture of wealth preservation built entirely on cryptographic certainty rather than geographical borders. Something to really think about.
The digital realm as the ultimate, borderless Switzerland. It forces us to reconsider the very nature of ownership and jurisdiction. When the global macro environment deteriorates and the future appears as murky as it did in May 1942, relying on hope or human intuition is a mathematical error. You must construct the radar. By mastering the mechanics of counterparty risk, engineering jurisdictional diversification, and strategically deploying capital into productive assets, you build an architecture that doesn't just withstand the panic, it structurally benefits from it. You engineer your own survival. Thanks for diving deep with us today.